we always have this problem of we know what we want to trade, you know what you are waiting for, but you don't easily see these things formulate. You don't easily see them where you're supposed to find them, and maybe other times before you find them, they've already passed. How do we counteract it? That is what we'll be dealing on tonight. This model is actually applicable to trending scenarios. Take notes, trending scenarios. Simply means if you want to trade this model and your market is not trending, you have to look away, look at somewhere else. This is very good for especially people who are still struggling with their market structure, trying to understand where is the swing high, where is the swing low. So using this model will actually strike out most of those queries and make them focus on spotting their entry signatures. This model is simple. First, pick two moving averages. You need to pick an intermediate moving average and a high moving average. So my intermediate moving average is the 50 EMA. I'm using exponential moving averages now. 50 EMA and 200 EMAs. 50 and 200. For 50, period 50, it simply means I'll be measuring average of 50 candles, and for 200, I'll be measuring average of 200 candles. Smart money concept, you know the relationship in between premium, discount, and equilibrium. Now, equilibrium is an alternative to average, actually. It's an alternative word to average, but when you use the word equilibrium, you are actually denoting an exact average point. Now, compare it with this, what we have here, moving averages. This is simply dynamic equilibrium. So an equilibrium that is moving. So I'll quickly go over explanation of our trends and come back to the lesson here. We have bullish trend, which is typically like this. Markets trade above previous high into a new premium zone, and then you have a new swing respect of here to here. Now you likely look for your entries in between or around in between discounts or around your equilibrium. So something like this, swing low to swing high, and this is my equilibrium. I want to look for entries that formulate only around and below my equilibrium. Since you are focusing on the equilibrium, anything around the equilibrium and anything below the equilibrium simply means a bullish market is likely going to trade, always likely going to trade from premium back to around your equilibrium, slightly to some discount, and then back to premium. Then your bearish market, the opposite way. Your bearish market is the opposite way. It will trade from premium into discount and back to around the equilibrium, back to around equilibrium, and so on and so forth. Now, once you consider the information I just gave out to you guys that your equilibrium is an alternative average, then you will understand what is actually going on here on the chart. Dynamic equilibrium in form of our moving averages. So the market is, the moving averages is always going to point out where is my estimated equilibrium at the time. Can you see this scenario here? This is a trending market. Now take note, I'm not going to be trading EMA cross, this strategy, this and that. I am just using this to show you simple points of interest where you look for whatever you look for to make your trades. Now I'm going to mark specific zones and go down to a lower time frame to illustrate what we'll be looking at for this zone, this another one. All of these zones I am marking out now as zones of interaction with equilibrium. This zone, all of these zones interacted with the higher moving average, which is the moving average 50, and this interaction occurred with the 200. Now I'm going to click on save and duplicate this chart. Now take notes, this is 1 hour time frame. Now for you to actually trade this model, you need to pick two time frames, the higher time frames for your point of interest. The point of interest are simply the point of price returning to the areas of the moving average. I'm going to open another tab for a lower time frame. I want to use 1 hour and 5 minute time frame as my lower time frame. So I do not need indicators in my lower time frame anymore. I only use the indicators in higher time frame to point out my zones of interest. The first one I marked is here. This is the first zone I actually did mark. The first box, which is here. Now, for people who struggle to actually identify and relate with their market structure, this is a simplification of market structure for you. This model is mostly suitable for continuation setups, not for reversal. Do not use it to trade reversal. Do not try to catch reversal with it. Just go for continuation trades with it. Trading this model will also take out one side of the market. Now, what we are framing out here is waiting for price to trade around the moving average and narrowing down to lower time frame, take from lower time frame and narrowing down to see the structure, study the structure, and apply whatever model we will be applying to trade that specific setup. Now, point two, how do we increase our probability? How do we know if this time price is likely going to bounce off the moving average? That is the essence of what we'll be doing here. Now, your market structure, you already know your market structure. Bullish market structure creates higher highs, higher lows, and bearish structure to create lower highs, lower lows. Consolidation, range bound here. If your trend is actually bullish and the bullish move is impulsive enough, you see your two moving averages distancing from each other and to the upside. If the trend is weak or the trend is consolidating, you see your moving averages crossing each other's time and often. Once you see the price below your two moving averages, you know you are only going to be selling because the market is now in a sell program. Take note, the market is now in a sell program. So you do not want to actually trade against the trend. The market is always going to have one impulsive side. The side toward the direction of the major trend is always the impulsive side of the market. So in a bearish market, the impulsive side will be market trading down. You do not want to mistake and start looking for bullish opportunities in market like this. But if I take out my moving average, it is possible for those who are not really familiar with market structure, it is possible they can see some things that can lure them into trading reversals. For example, some people can see a support maybe around here and start to trade reversals. But by the time you add your moving average to understand your market structure clearly, if you are struggling with your market structure, you will see that the market is actually in a sell program here. So this is simplification model of your market structure. So this is the zone I identified from the high time frame EMA, which is the 1 hour time frame here. This is the zone. How will you know if price is going to react from around this zone? Now take note, these zones, we are using them as our points of interest. Point of interest, nothing more, nothing less. Point of interest simply means you'll be focusing on this zone and looking for signatures to support your buyers in the market. We are in a buy program because price is above the two moving averages and the two moving averages have distance from each other around this zone here, as you can clearly see. Now I'll navigate to find the lower time frame of it, taking out the indicators. I'm not using any of the indicators anymore. I only use them to spot out my points of interest. This is the zone here. Now, price traded into the zone. What can you see from this zone? Can you identify any model? Can you see anything that supports reversal from the way you trade? Now, from the way I trade, yes, I can see things that support reversal from the way I trade. For example, there is a swing high here. Here, if there is a swing high here, I just switched to line chart so you can clearly see that this point is a swing high. Back to candlesticks and boom. Here, a swing high here. Looking at this point, I'll be looking for whatever I know will be my entry trigger, waiting for a retracement, default model like this, maybe after violating this high. This creates a higher high. I want to see price trade back into the zone and maybe into equilibrium. If you're lost about what I'm talking right now, I think I'll pin a video to this particular section once I post this to YouTube about the video that talked about market structure. Fine. So anticipating that this is a bullish market right now, I'll be waiting for price to trade to around equilibrium for me to pick my entry. But boom, I missed that retracement back to equilibrium for me to actually pick my entry. So keep looking for all of the models on these points. Can you see anything after this point?
Yes, sir.
What do you see?
Yeah. Fair value gap.
Where is it?
It's in between the first and the third candle.
The large impulsive candles there, where a retracement took place. Move up.
Okay, I think you can draw on the screen. So if you can identify it, draw on the screen.
I don't know how to do that.
Okay, you don't know how to draw on the screen. Let me of this point. Before you actually jump into your trade, you want to make sure that the big boys, the institutions, are actually participating in the trade. And for you to actually know that they are participating, the market must be impulsive. That means the direction you want to trade to, market needs to trade toward that direction aggressively. So all you want to do is wait for market to reprice a level it has traded off aggressively. An area price has displaced. You want to just wait for price to come back to that zone. Now, if you look at this point, you will see a fair value gap. It's one.
Yeah, that's it.
Okay, cool. If that's yours, that's cool. That is one. This is another one. Now, if it's about what is fair value gap, please refer back to our YouTube channel. You see the content on fair value gap there. Fair value gap number one, fair value gap number two. So you know you will be framing your entries around these zones. You know how to refine your entries when you have a wide range like this. All you have to do, narrow down to a lower time frame and wait for a break of structure. And where did that happen? If you go to a lower time frame, it is here. Without the break of structure, you see price just trading back into this fair value gap, filling it, not violating it here, and you see the whole reaction. All of this resulting from the momentum of this high time frame program. Take note of this high time frame program. I mean, 5 minutes now, this whole program occurred in 1 hour. That is where I identified the zone here. So you want to know when to jump into the zones. You want to see evidence that market is actually going to react from your zones before you jump in. But all I just did with these moving averages is to spot points of interest. Take note, I only used it to spot point of interest. Coming to the lower time frame, you won't see me still using the moving averages here. So this is our point number one, which I identified. I'll go to the second point and see how price reacted in that zone and see what we could have made of it. So this is the zone, second interaction here, which is this point. So price has traded to this moving average now. How will you know if price will react away from that moving average? You come back again to the lower time frame and look for bullish signatures. So whatever suggests bearishness, you will not be taking it. Only stocks that suggest bullishness is what you will be taking in this particular section. For example, see market creating a liquidity here, previous low here, major swing high here, which was violated with just wicks. So this is not a dominant and impulsive violation. So you know all of these price actions are actually range of internal liquidity, and it is occurring around our point of interest. Take note, it's occurring around our point of interest. Now, we took out all of this liquidity just to form a high, a low, lower low here, almost relatively equal high or by some margin, and then a lower low here. Now, take note of this point. I'm marking all of this as relatively equal highs. Relatively equal highs. Project it forward. It means this is the point market violated all of these relatively equal highs. Now, if you look at how market violated this zone, can you not see how impulsive it is? Now, seeing this is an evidence that price is willing to trade away from the moving average, traded impulsively away from it. This is the zone of the moving average, traded impulsively away from it. Now we have this as our major swing high, major swing high, major swing low, and check in respect to premium and discount. Which section are we in? Boom. So you see price from the moving average, break of structure to the upside, internal range liquidity, took out the liquidity here, retrace deep into discounts, and bought its way up from discounts. This is discount to premium, market retrace from premium back to discount after a break of structure. So you know this is a buy program. This is a buy model, but it is occurring around our point of interest. So we have a structure that looks like this. Fine. So we have a structure that looks like this. So I'm sure most of you will identify a structure that looks like this to be a bullish program as a verification that market is likely going to go up. But now look at where you spotted it from around here, which is high time frame equilibrium, high time frame average. Once your price trades to around the moving average, take note, it's not a pinpointed point now. Like, I'm not going to pinpoint the moving average from maybe the higher time frame and say just exactly the moving average. Once your price is around it, it becomes your point of interest. Why? Because market has traded back to an equilibrium. So from around your moving averages, you want to see if markets will give you signatures toward the direction of the major trend. And if you see that, you take it. So understanding the moving average, you've already taken out one program away from the market. You're not going to be looking for sell opportunities in this market. You won't be countering the trend. You will be trading towards the direction of the major trend, which is still the impulsive direction. We have another point of interest here. Let us see what is inside of it, how we can break it down. All you have to do is go to your own chart and try to see these same things too. By the time you backtest and you are able to see these same things, once you are live in the market, you won't be fearful. When you see this model, you will actually be able to implement it very well. Here, another point of interest, which is the third one. We are focused on this one now, the third one, third point of interest. What do we have inside it? Look at how price approached it. Your bullish trend, you know this is your impulsive move. This is your retracement or your repulsive move. Impulsive move, fine. Now, this retracement move in higher time frame, it is going to in a lower time frame. This retracement move in a lower time frame is going to appear as a trend because you are in a lower time frame. This is it here. Lower time frame trend trading against the higher time frame major trend. Now, what you are watching here is for a break in the lower time frame trend. This will validate that price is willing to trade toward the major trend direction, the higher time frame direction. Series of lower highs and series of lower lows. These specific points here, a high. This specific point, a lower high. Major high, short-term high, and then the major low. Irrespective of the one you took, price actually did violated. Price violated this one and this one here with this impulsive move to the upside. As you see this impulsive move, all you'll be looking for is for entry triggers. You'll be looking for your entry triggers, be it your order blocks, your fair value gap, your retracement into discounts. But all you know is after seeing this impulsive move away from your point of interest, which is a moving average in the higher time frame, you'll be looking for entry triggers just toward the bullish side of the market. Now I'm going to zoom in and give you all the same task. Do you guys see any bullish entry trigger around here?
Fair value gap. I can see a fair value gap there.
Okay, can you point it out on your screen, on my screen?
Yes, a bit.
There are actually series of them. There is no, I can't see a fair value gap there. All right, you can stop drawing now, sir. Thank you. Thank you very much for your comment.
Right.
Yeah. So outside the fair value gap, there is something you should notice. There are several things you should notice before trading toward the direction. You want to see break of structure. You want to see displacements. You want to see probably fair value gaps, order blocks, and good impulsive candles. Good impulsive candles that will suggest that yes, the market is trying to switch from the sell program to a buy program. Now look at this whole range. Can you see the candles? They are really impulsive and very consecutive. So we even violated all of these highs before we had a bearish, this kind of doji, is it dragonfly, what they call it, whatever they call it here, before we had it here. So there is evidence that something got into the market here, which is pushing price, displacing price to the upside. You can see displacement. We violated all of these highs. There is a fair value gap here, and a small one around here. I'm going to be focusing just on this one, although we didn't use it, but an easy one price is supposed to reach out to. Now, all you had to wait for to do was just see price trade into this zone from even a lower time frame and watch for a break of structure toward the upside. That is how you should have used this fair value gap if this prognosis did play out this way. But since we didn't get it this way, we look for other things. We look for other models. We look for whatever is forming. All you have to do is sit on your hands and observe price. That is all required from you to do. Sit on your hands and observe price. You look at this region. Price created the series of higher highs and higher lows, but overall, we know this market is in a premium. So looking at all of this, if you link a trend line here, you see there is liquidity below those zones. By liquidity, I simply mean stop losses below all of these zones here. Now you can see the market trading from this high, taking out all of those stop losses. So it has taken a good level of the liquidity available here. And the bookmark it traded back to is to this bearish candle, which this one here is another block that resulted to this impulsive move. And you see price taking out all of this liquidity, trade into the other block. And if you go into your lower time frame, you will see the same thing. The market is fractal. The patterns, they keep on repeating. They keep on repeating. So in this section, you see something like this. See something like this. And a break of structure in even the tinier time frame, maybe the 1 minute time frame. If you don't do that, you will see just the normal engulfing. This is a bullish engulfing candle here. Look at how impulsive this candle is. So you know price is respecting this zone. So after seeing this kind of impulsive move, all you have to do is wait for retracement to, since you are in a lower time frame now, you don't need all of the modification, all of the refinement. Once you come back to equilibrium, you want to jump into the trade. That's exactly what did play out here. Major swing low to the major swing high here, and back to the equilibrium resulted to this impulsive move. All as a result of the impulse, the momentum from the high time frame point of interest, which is generated from this specific. This is the failed one here. This is the EMA. Price trade back to it, and it becomes our point of interest. Anything around that price range becomes our point of interest. What we'll be doing now is to go into the lower time frame to look for evidence of bullishness, to show that price is actually going to respect this EMA around here and trade back up. Now, this is the same point. Can you see any evidence of bullishness? Anyone? Can you see anything that will trip you into a bullish trend in this particular section?
No.
Fine. So if it is not an oversight, you won't be mistaken into trading this specific position. It's this simple. It is your point of interest. If it gives you bullish signature, you go in. If it doesn't, you don't. If it misses the first one, it will trade to the second point of interest, which is the higher time frame equilibrium. Misses this one, you anticipate it around the second moving average you are using, which is even another higher time frame equilibrium, which is here. Look at this. High, a low that is lower than all of these previous lows, a lower low, and then internal range liquidity price action there. Extend it forward from this high to where it was violated here. Here, the last major swing low. So you see the violation of the structure here, and then if you measure from the major low to the high, to this new high that is formed now, what did price do? Here, trade deeply into equilibrium and bottom from there. And where specifically did it trade into? In the discount, into an order block here. So can you guys see the model, like picking your point of interest and then coming back to apply whatever you know? Is it complicated? Is it difficult? Are you finding any difficulty using it or understanding
No.
it? Fine.
We're not.
Here, again, the point of interest, 1 hour time frame, which is the higher time frame moving average. It's literally the same thing. Same thing I've been explaining. Low, high, break of the structure here, retracing to discount, and this will buy. I've seen like a lot of feedback of people trying to trade and they don't understand their market structure. That's why I came back with this lesson, to make it easy for you guys to apply. The decisions are not indicator based. Indicator only points out point of interest, which is actually our equilibrium, and you know how your trends are supposed to trade. You can actually see how I'm applying the moving average indicator here. It's not me trading EMA cross or this or that. I'm simply using it to point out specific zones as my point of interest in my chart. Take note, do not forget, I said this model is best for continuation. So don't try to use it to trade reversals. You can use whatever model you know to trade your reversal, but this is best for continuation trades. From what you can see here, for us to begin with, which program is the market in from this section to this section? Here to here, which program is the market in? It is bullish, which means actually a buy program. As long as 50 and price are above 200, I will be buying. As long as 50 and price are below 200, I will be selling. If they are crossing each other randomly, I do nothing with this model. If you look at this section, we crossed to the upside, and you can, taking out the indicators, you can see that we are clearly in a bullish program. So do not limit yourself to just looking at the indicators. Find confluence in everything you do. Look at these points. You know your bullish trend, higher highs and higher lows. You can see it clearly, and then you see the EMA even crossing. Now you are sure that we are fully in a buy program. Let's assume you missed this one because you felt like, okay, this can still continue to the downside, and then you want to go in here. It is the same thing. If you go into the lower time frame, you will actually spot the break of structure to the upside before this whole impulsive move, the whole impulsive stretch of this major swing. Now, what can you see here? Look at the equilibrium. Look at the high time frame moving average. Can you not see these two things are pointing to the same level, the high time frame average of the whole stretch of the trend? 50 is the average between 0 to 100. And that is exactly what is pointed out here from the moving average, and the same thing from the Fibonacci into the lower time frame for us to actually look at these two setups. Here is the last two setups. Into the lower time frame, I do not need indicators anymore. I only use it in the high time frame to pick my points of interest. Now, this is the first one. This is the first one. Can you guys see anything according to the model you trade? Can you see anything that warrants reversal? It's likely going to be yes. If you are trading just with the pure structure, you can see market creating higher highs and higher lows. And at this point, which is around the moving average, what happened here? A violation of previous low, a break of structure to the lower side, and then retraces, sell. But you can see that after trading to the high time frame moving average, which is your equilibrium or average, let me actually draw in my Fibonacci to measure this one to see what it will be pointing out. This is the leg, last leg before this major swing was formed. And where was that? Can you see? The moving averages are actually around my premium zone. Come to here, this zone around the moving average. What price model do you see? Higher highs, higher lows, break of structure, retracement, and sell. Come to the next one, which is this one here. Price trade back to around the moving average. Take note, I told you it's not pinpointed price. You're not picking the moving average specific price. You are looking at the price action around the average. Price will trade deeply into the discount zone. Other times it will just react from around the equilibrium zone. So but all you will be doing is watch out for the move around the moving average. Let's watch this move and see what happens there. Can you see any signature that support bearishness? You are only focused on trading toward the bearish side of this market now. It's at a higher high, and if we trade back to something, another block here, blah, 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 you buy. Nope, that's not the case here. The whole market is bearish. The high time frame is bearish. Can you see it? But the low time frame is bullish. So all you'll be doing now is to watch out for this bullish trend to break and sell in continuation of the trend. Take note, I told you guys this is best for continuation setups. Trading this model will take out one part of the market totally. So you won't be looking for bullish setup anymore. You just be waiting for the bearish setup around the moving average. And that is what we have here. A violation of low here. And then retracement. All of the models, all of the stars, they did align in this one. A block break of structure to the lower side, impulsive candles, fair value gap, trading to the fair value gap, sell. Can you see it? But around which point did it happen? Here, around your moving average. So I'm sure this model will actually make it easy to spot very good zones as points of interest. This will help you take out the unimpulsive side of the market, and it will help you to trade probably to the right side of the market, the major part you want to trade. So far from the explanation, while I was explaining, is there anything someone was not clear with? Questions? We're almost running out of time now. So we have 4 minutes and 18 seconds left. So let us use this to discuss and to clarify points which we are not clear with. Sorry, let me coordinate this. So if you have a question, raise your hand via the Zoom and I'll call on your name for you to speak. So it will be coordinated. Also type your question in the chat box. I will go through it too. All right, so Jude, go on.
Okay, please give us like a conclusion of the whole process.
Conclusion.
Yes, from top down.
Okay,
major points we can hold from here.
Okay,
we can expatiate on them later.
All right, cool. Application of this model is for a trending market. 1, 2, when you pick your moving averages, pick a high moving average and a low one. In my own scenario, I was using 250 exponential moving averages. So you only apply these moving averages in the high time frame. Price returning to the zones of the moving averages means your point of interest. You zoom in and watch closely what is happening around those zones. The lower time frame, you do not need the moving averages anymore. Then before you trade toward the direction of the major trend in the lower time frame, look for price signatures in the lower time frame that support the higher time frame direction. So for example, this market is bullish, it doesn't support the high time frame direction. This break of structure support the high time frame direction. It's breaking toward the sell side. That is to tell me that price is about to continue selling. The setup is best for continuation setups. So trading this model will also help you take out one side of the market. You'll be focused on just one side of the market, which is the major direction of the market, the major trend of the market. Then once your price and EMA 50 is above EMA 200, only look for buy opportunities once price reverses to your EMA zones. Then once your price and EMA 50 is below EMA 200, only look for sell opportunities. Do not limit yourself to looking at just the indicators. Apply what you already know. Look at the market structure from the bigger picture and see if it is actually maybe forming something like a reversal, and know when to keep clear of the market. When the market is trending with good momentum, that is your best bet. You hit good level of accuracy.